Hi, I'm James Dunn. Welcome to the Inside Network.
Joining me in depth is Bob Desmond from Claremont Global. Bob, welcome.
Thank you, James. Good to be here.
It's very good to have you. Bob, you've described the Claremont process as quality growth. So what really makes a quality company?
I would say the key attributes we're looking for, that they have something really special in their product or service, that where consumers really need that product or service, and and that reason that the consumer buys it does not change over time. It's very stable, and call it enduring competitive advantage or whatever you want. And ideally, you want that product or service to be a very small part of the total cost of budget or whatever you're spending. So we're looking for low cost of value, a really needed attribute, very high switching costs, and in the end, what that results in is a very high degree of earnings predictability. That's what we're really looking for.
How did you personally develop this mindset and become a quality growth investor? Were you always focused that way?
I have been, actually. I mean, I guess where it comes from is initially starting in Zimbabwe. I think there were only 60 listed companies on the stock exchange. Maybe 40 of them were rubbish anyway. And then 10 were good, but probably 2 were liquid. And then, so I think when I started, I actually inherited a portfolio of 60 companies, and within a year, it made sense to me to just own very highest quality. But also, because Zimbabwe was such a mess, hyperinflation and all those other things, and you just had to be in the best companies. And this just always stuck with me. It makes sense to me. Buy the best, focus your capital in the best companies, buy them at the right price.
And be obviously a very high conviction investor with a small number of stocks. But what does that pan out in terms of your average tenure of holding?
Well, we do have stocks in the fund that we've had for 6 years. To give you an idea, it's probably somewhere, our turnover is probably around 25% maybe. It has historically been higher than that, but over the last couple of years, it really has dropped. There's a lot of companies we wanted to buy for a long time. We own them now. So last year we bought 4 new stocks into the portfolio. This year only 2. So we really do want to buy growing businesses at the right price and ideally hold them for forever if we can.
How many transactions a year are you making? You just mentioned new holdings, but do you do a lot of trimming? And
yeah,
adding?
we do top and tail. So we always manage to value. Mm-hmm. So generally, as a stock price, if all goes well, the stock price is going up, we will narrow the position and recycle that into where we see better value, either within the portfolio or bring in a new name. So we do make sure, one of the things with quality growth investing you have to be very careful of is you don't become a momentum investor and fall in love with a stock. So you always got to be really disciplined around your valuation. Otherwise, you move from quality growth into momentum, which is something completely different.
And making that decision to effectively admit that you've got something wrong, how difficult is that, and what processes do you put in place to really make that as easy as possible?
Yeah, no one likes to admit they've made a mistake. I think one of the good things with the 10 to 15 stock portfolio, there is nowhere to hide. So your average position's got a 6% weight, and so you can't have passengers. So I've heard people say, "Oh, I'm going to wait to get back to what I paid for it," or "It's a small part of the portfolio," or "It's cheap." We just don't think like that. So we actually recently made a mistake. I don't really want to talk about it, but if you want to, you can ask me. So we recently made a mistake. The thinking that went into it was, okay, we'd lost 40%. The stock price had fallen 40%, so it was a bad mistake. And so the thinking that goes into it is, okay, that money's effectively lost. Now from here, we don't have to make the money back in that stock. That stock owes us nothing. So from here, what are the best opportunities today? And we actually found a different stock where the return opportunity was pretty similar, but with a whole lot less risk. So when you've made a mistake in investing, our approach always is, unless we're prepared to buy more of that position, then we will cut it, because it means we don't really have conviction and we actually got hope And there's so many companies in the world. Why, if you're not haven't got conviction, cut it, move on.
Can you tell us what the stock was?
Estee Lauder.
How long does the process take from first ideation and an analyst suggesting it and the team assessing it all the way through to entering a position? How quickly have you done that, and what does it normally take?
Normally would be years. Well, actually, we have two processes. Normally, to bring something to fruition could be 3 or 4 months on average. So the way we normally work is I might find something interesting. I'll write a 2-pager on it for the team. They'll look at it, and very quickly, we do. If 2 of the analysts say, that's actually a piece of rubbish, I'll obviously speak to my co-PM. He says, listen, I'm never going to buy that. Let's just shut down straight away. Then if it's kind of a go, then we'll probably take 3 or 4 months to develop that idea, and that'll be speaking to the company, speaking to their competitors, speaking to expert networks, to just get a really good sense of that. More often than not, that if that's approved, then that comes onto what we call the approved list. But more often than not, it won't go straight into the portfolio, and can often be many, many years before it gets into the portfolio, because it only gets into the portfolio when it's at the right valuation.
Do you keep a watch on any sectoral or geographical biases that might be emerging, or simply say, no, these are the stocks we want, and it's just
No. We do have strict limits on sectors. So 25%, it's a soft limit, but 25%. So if it goes to 26, we don't just suddenly cut it. But 25% limit by sector, and we don't use GICs. We use really more business owners' mentality. What are the earnings drivers? To give you an example, we've owned in the past something like Sherwin-Williams, which actually in GICS sits as an industrial paint manufacturer and also a distributor. But if you actually look at the business, most of the profit comes from retail. So we treat that as a consumer business.
Mm-hmm. How are you playing the AI sector, for example? What kind of stocks, or take that back a bit, do you want to play thematically like that, or is something like AI really unignorable?
We don't do themes. I think they're very, very hard to get the theme right. And then not only do you have to get the theme right, you're then going to have to pick the winning investment in that sector. More often than not, when a theme's really hot, there's going to be some new names that are going to be really expensive, so you have to get the valuation right as well. Or our investing, so something like AI, how we've looked at it is we already own Microsoft, Adobe, and Alphabet. But they are really well placed in a world of AI because they have huge amounts of data, they have lots of processing capability, so those are 2 key attributes you have to have. They have scale. So we don't kind of try and... AI for us in that is icing on the cake. We didn't buy those businesses because of AI, but it's going to be icing on the cake. And most importantly, it's going to deepen their competitive advantage. And that's what we're really excited by.
What sectors, if any, do you avoid?
We avoid huge parts of the market. So we avoid banks, insurers, commodities, pharmaceuticals. We do animal healthcare, but human pharmaceuticals. Basically anything that I say is utilities, regulated, commoditized, leveraged or commoditized, we just stay away from.
What sectors are exciting the team at the moment?
We generally stay in the same sectors. So if you look at our portfolio, we love financial planning, something like a Visa, tech staples, like I mentioned, Alphabet or Microsoft, business services, something like insurance broking, brands, something like Nike. Healthcare, we don't do human pharmaceuticals, but we like instrument businesses or animal healthcare. And then the only other sector we have been in, not at the moment, is niche industrials. So not things that are linked to a capex cycle like a Caterpillar or a Deere. More niche industrials are something like a Sika or a Nordson. And that's all we actually invest. That's where we feel really comfortable, those sort of sectors. So we say on the website, own the world's best businesses. We think like business owners. And those are industries where we think there's very stable industry structures. They are sort of industries we can understand. And that's kind of all where we invest.
What's the typical time frame you find you need to or end up giving a position to achieve what you expect and hope from it?
It doesn't really depend on time. As long as the company is delivering the earnings that we're looking for and the earnings are growing and the value of the business is growing, we don't kind of go, well, we've owned it, to give you an extreme example, let's say we bought something and the earnings, say, had doubled over, 5 years, let's say, and the stock price had hardly moved. We wouldn't sell because the stock price hasn't moved. I mean, that's an extreme example. As long as the company keeps delivering profits, we will be there, and the value is increasing, we'll stay there.
What's an example of a stock you still kick yourself over not buying?
That's actually a good question. I'll give you a strange answer, actually, and it's not really connected with the fund, but it's actually, I could have bought a company in Zimbabwe called Zim Sun, which owned all the hotel chains. So they had, from memory, something like 7 hotels. They owned the iconic Vic Falls Hotel, if you've ever been to Zimbabwe. They had thousands of hectares of timber. And I think in the crazy days of hyperinflation, the market cap got something like $5 million or $7 million or something crazy. That I could have really, that was something that was, when I look back now and go, well, why didn't I buy it?
What about ESG, Bob? Do you spend much time thinking about that? Is it actually an overlay or just part of quality, in quality growth?
Yeah, for us, we're not like what we say to our clients is if this is really, really important to you, then we're probably not the fund for you, and you'd be better off at one of the, we put it front and center. Having said that, it is a key part of the process for us. So for me, ESG is just good culture, good governance, treat your shareholders fairly, look after your employees, don't do horrible things to your customers, look after those types of things, because actually it's good business. So whenever we buy a company, we will spend time looking at the culture and trying to track down ex-employees and get a sense of what is the culture like of that company. So I mentioned Sherwin-Williams before. You can see when you talk to them, and I've spoken to people there about how they think about ESG. And so, for example, they say ESG is good business for them. So if they have a more diverse workforce, well, that's great, because that's what their customer base looks like. If they look after the environment and produce a paint that looks after the environment, well, that's good business, because they can charge more for that. If they look after their communities and their employees, they have one of the lowest employee store manager turnovers in retail, well, that's good business, because it's really great for their customers, and they don't have to keep replacing managers, really expensive to do. So for us, it's just an outcome of the process. But we will not invest in a company where we feel there's a problem with the culture or how they treat customers.
What about your own culture? It's a small team. What are the attributes that you absolutely must have in a team member, and how in a small team do you really build diversity of input?
Yeah, that's a good question. I think like must have, small egos. It's a really difficult profession, this, and we make mistakes, and so when you make a mistake, own up to it, and just put your hand up and move on. Definitely working as a team is hugely important to me. So not just championing your own ideas, and then just not really caring what everyone else is doing. I think that's really, really important. I think just being patient. So if you're someone who wants to trade markets and read up about the latest hot thing and really just always really active, you have to. For us, you generally have to enjoy following great businesses. Finding out what makes them tick, what's their competitive advantage, what's their culture, why do their customers buy them, and it might not be cheap enough to buy for years. So every quarter you're updating the numbers, speaking, just kind of deepening your knowledge. But it's not about just getting it into the fund tomorrow. So you have to have the patience for that.
And what about on the investor side? How difficult is it sometimes to you look for patience in your employees, but sometimes you can't sack clients. Are you ever frustrated when some clients really lack the patience for the strategy to suit them?
To be honest, no. At the end of the day, the client, that's their money, it's their capital. They can do they can do whatever they want. It's their money. It's not our money. What I do enjoy though is where we have a meeting of minds. I mean, we know that 10 to 15 stocks is not going to be for everyone. We know that there's just going to be customers or clients who want us to have a view on markets or interest rates or driverless cars or whatever the latest theme du jour is. We make it just really clear to them that, by the way, I hope we make it clear that this is what we do and this is probably not going to be a good fit. And I think you kind of self-select the clients. But what's really rewarding is then once you have that client, and we've had clients who we've had for over a decade, and maybe at the beginning they're like 10 to 15 names. That's ooh. But as we've kind of taken them on the journey and explained the process and the philosophy and the businesses that they own, it can be rewarding, really rewarding for them and for us.
What's the current funds under management figure, and what would be the figure at which you think you'd have to say, we really, for the strategy to work the way we'd like it to, we shouldn't take any more money?
We're currently 1.4 billion, give or take, and I think we've said we would cap the strategy between 7 to 10 billion, because once you get above that, it gets really hard to deliver those returns for clients, and you just get complexity. More clients, more client service. We can only buy mega caps. You get bigger and bigger. So what we really want to do is get really good outcomes for clients, give them really good service. So we don't think we can do that much beyond 7 to 10 billion.
What are the capitalisation parameters?
We can drop by mandate to 3 billion. I would say we do have a liquidity constraint, so anything we buy, we want to be able to exit that position in 10 trading days, no more than 25% of the volume, which, give or take means we're normally dropping down to about 10 billion.
And that's US dollar figures?
US dollars, yeah.
This has been In Depth with Bob Desmond from Claremont Global. Thank you, Bob.
Thank you, James.
It's been a really interesting chat. I've enjoyed it.
Thank you.